So the S&P 500 is up 13% in the last month. The 10-year yield continues to go down. Does this mean that the bear market is over? A couple of things here. If you watch my last video, I talked about how the Fed completely flipped the market during the last FOMC meeting. Jerome Powell basically came out guns a-blazing, said that, hey, we're at neutral already. Now, for those that are not up to date in the Fed lingo, neutral basically means the rate at which you don't need to do any more tightening or relaxing of monetary policy. He also said that we're not in a recession, even if we get back-to-back negative GDP quarters, which happened the day after the FOMC meeting. The second thing is, if you watch my video titled that the market will insanely rally if something happens, I talked about how the only outlier left that was an unknown were earnings. The CPI was already known at 9.1% year over year because that came out way earlier. The GDP being negative was most likely priced in, so a shallow recession was priced in because the Fed Atlanta tracker has been saying that the US economy has contracted. They've been saying that for weeks before the GDP numbers came out. Thirdly, I think that the Fed rate hikes, whether it was 75 basis points or 100 basis points, that 75 to 100 was already priced in because the Fed had telegraphed that well before. So the fourth and only outlier to determine what direction the market would take in the short term were earnings. Well, the major earnings season of mega cap companies, especially mega cap tech, which leads most of the indices weightings, were actually decent. And if the earnings were missed, then the guidance was positive. So that really gave a runway for a short-term rally. But is this rally sustainable? Is the bear market over? We will go through all of this in this video. I have some very pertinent data, and you definitely want to stick around, especially if you care about your portfolio and you care about your money. Now, right off the bat, I want to tell you that if you missed the bottom in June, don't fret. Most people will not catch the bottom. This is why it's important to keep investing in a downward market. Now, you could do this in a myriad of ways, especially if you know how to trade options. So before we get into the data, I'll show you what I mean. Back in May, we sold cash secured puts on some of the major stocks that we wanted to own: Apple, Tesla, the triple Qs, Microsoft, and we're essentially naming our price through the selling of put options. Now, you'll be obligated to buy 100 shares of each of these stocks if you get assigned, but you get to name your price. And if the stocks never reach those prices, well, then you get to keep the money that you sold those cash secured puts for. So that is one way that we invested in the market. Obviously, you can continue to dollar cost average in shares that you are fond of as the market goes down and hits key levels. Also, regardless of whether it is the market bottom or not, when we are in bear markets, and even worse in recessions, well, actually, history shows that that is the perfect time to invest. The average investor is the most fearful during these times, and that is when they capitulate and let go of their shares. Well, who are they selling their shares to at a discount? They're selling their shares to smarter investors, or what we call the smart money. That is who you eventually want to be. In the Traveling Trader Academy, I will be starting a portfolio as well that you can track to show you how I would invest in this type of market and why I always preach sticking to blue chip stocks and indices as opposed to trying to hit home runs with bullshit high growth stocks, to be honest. We obviously send out our day trade watch list as well to show you where are the key levels that we are buying puts and calls. Today, we are banking on the CVX puts right here. Chevron is tanking after earnings, and we're expecting it to fill this gap here between 151 and 152. We're actually very close to that. We also just released an options day trading course last month. You obviously get access to the options course as well, the popular options course, the Zoom calls, which we had one this week. You get access to the day trade watch list, the weekly stock watch list, and market updates. You get access to thousands of traders that are trading all day, every day. It is really a great value. Sign up below to apply with one of our ambassadors if you are so inclined. Would love to have you. So is the bear market over? Let's take a look at the S&P 500. I highlighted this before, but back in March, April, earlier of this year, we created this sort of Adam and Eve pattern, or you can call this a backwards cup and handle. And we are forming the same exact pattern now. Funny enough, going into earnings, the same thing back here in March, April, when we had the last round of earnings. So the S&P 500 is at a key level here. Now, remember that the next CPI numbers come out August 10th. So right now, as of the time of this recording, it's August 4th. Now, we came at the highest inflation in 41 years at 9.1% year over year. Here's what's going to happen. Based on what the Fed projected, that we are at neutral. So basically, they are signaling that they're going to soften their stance in the future, which is part of the reason why the market is rallying, as well as the fact that companies gave good guidance. If the CPI comes in less than 9.1%, especially if it's significantly less, then I think the market can continue to rally and break out of this. If the CPI comes in around the same level, or worse yet, even higher, then I think the market will start its next leg down, or at least come back to retest this bottom here that we saw back in the middle of June. Now, here's another statistic that I found that's really interesting. It takes about 19 months to recover from a bear market, according to Ryan Dietrich. However, going back to 1982, so 40 years ago, if the bear market does not go down by 30%, the recovery is usually very quick. In 2020, the famous COVID crash, that was 5 months, 2018 was 4 months, 2011 was 4 months, 98 was 3 months, 90 was 4 months, and 82 was 3 months. So if the CPI numbers come in and they are significantly lower than 9.1%, and they show that inflation is finally trending down, then I think that the S&P 500, it might be rocky, it might not be a straight shot up, but I think that it can start to make the next leg up, especially as we said, the Fed is being rather accommodative here. This will further signal to the market that the Fed is not going to have to do as much to fight inflation because inflation is trending down. Whether that signal is accurate or not is a different story. One other data point that I talked about before is that when the S&P 500 hits a 52-week low, and the next 2 out of 3 days have an 85% up volume, meaning that 85% of the volume is in advancing stocks, that has signaled a bear market bottom going all the way back to 1962. And we actually hit that in the S&P 500. We also have another breadth thrust indicator that has successfully signaled bottoms in the market going all the way back to 1950. This is where the ratio of 10-day advances over 10-day declines, that is advancing stocks over declining stocks over a 10-day period, almost hits a ratio of 2-to-1. We just hit this last week as of the time of this recording. So what does all this mean? Is this the end of the bear market? Well, honestly, it could be if the Fed policy remains rather accommodative. Remember, the Fed drives a lot of what goes on in the market because the Fed controls the money supply and the interest rates. And if the Fed is signaling to the market that they're not going to be raising rates aggressively anymore, well, then the market is going to be rather risk on at this point. And you could see this also reflected in the bond market. Bond yields have hit a 4-month low because bond investors are actually pouring into bonds now. Remember, when there's a high demand for bonds, bond yields tend to go down. But they're pouring into bonds because if they believe that the Fed is not going to raise rates significantly in the future, and the Fed raising rates has an effect on bond yields going up, well, then they're going to try to get the highest yield that they can, which if they think that the highest yield is right now, because the Fed is not going to raise aggressively any longer, well, they're going to be pouring into bonds to try to clamor and get those high yields, or at least the highest yields that they can get at the moment. However, nobody knows what CPI is going to come in at on August 10th. And August is usually the worst month for stocks during a midterm election year like the one we have currently. So if we start to trend lower in August to retest at least the lows that we saw in June, in my view, that will be a buying opportunity. I'm not going to pretend like I know when the exact bottom is. However, the way that I approach it is I look at stocks that I want to own. If they are at enough of a discount for me, I don't really care if they go down further. If Microsoft, Apple, the triple Qs, Tesla, if they are 30, 40% down, and those stocks rarely ever get to 30, 40% down historically, then I want to buy into those stocks for the long term because I'm not investing for tomorrow or next week. I'm investing for years. And you might not even need to wait that long for an investment in blue chips to pan out. Those who buy stocks the day that the S&P 500 enters a bear market have made an average of 22.7% in the next 12 months. And those who invest in recessions see 12 months return after the bear market ends of around 48.8%. This is why I was so happy to sell cash secured puts in May, because that was the time that a bear market was concluded on the S&P 500. I didn't care if that was the bottom or not. Now, in hindsight, I should have been buying a lot more stocks in June, but nobody knows when the bottom is going to be. And we still had earnings on the horizon, which to me was a major outlier. What if companies came in, reported terrible earnings, and didn't give guidance or reported terrible guidance, well, the market could have tanked further. And I had a lot of capital tied up in those cash secured puts anyway. So in short, will I be doing investing here? Well, no, because the S&P 500 currently is at a key resistance level, very similar to what we saw back in March, April. So I will not be investing here. What I will be waiting for is if we do see resistance and another leg down, well, then I will likely start buying more into stocks. And again, I don't care whether it's the bottom or not. I'm going to start investing in stocks that I like that are at major discounts because I'm investing for the long term, 12 months and out. And I may never get these discounts again. If you want to track my investments and what I will be buying, when I will be buying it, link is in the description below. So come be a part of the academy. If you got anything out of this video, leave a big fat thumbs up just like this. Leave it in the comment section below. Let me know if you're buying. Let me know if you bought. Let me know what you think of the bear market. Are we close to being over? Do you think we see another major leg down or just a small leg down? Or do you think we rocket back up because of the Fed's accommodative policy? I love hearing from you guys. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.